Typically, when we think of companies monetizing their receivables, we're picturing them simply collecting the cash from sales made on account. However, some companies are going to choose to get value from them in other ways. And maybe they're doing this to receive cash a little bit sooner, to improve their liquidity. Maybe they just don't want the hassle of collecting from difficult customers. Now, the two main ways that companies do this is either using them as collateral on loans, which we refer to as a secured borrowing. Alternatively, they can sell their receivables for cash to a financial institution, often called a factor. So we would refer to this arrangement as the factoring of receivables. While these two different types of transactions are conceptually distinct, in terms of their appearance or form in the business world, they can actually look pretty similar. And as we'll discuss later, it turns out that the accounting treatment for the second option, the sale of receivables, that's generally more favorable than that of a secured borrowing. So as a result, FASB requires 3 criteria to be satisfied in order for a financing arrangement to be classified as a sale. First, the transferred assets must be legally isolated or beyond the reach of the seller and, importantly, its creditors. Essentially, this means that if the seller goes bankrupt, its creditors cannot reclaim the value of those receivables. Second, the buyer has the right to monetize them. They can start collecting from the original customers or pledge or exchange them in turn. Third, and relatedly, we're going to go back to that recurring concept of control, where the seller must not maintain effective control of those receivables. Companies can try to intimate that a sale has occurred, but the contract might include a clause about the ability to repurchase or reclaim the receivables in the future, or substitute for other assets. These examples would violate this third criterion because the buyer should be able to manage the receivables without any future interference of the seller. I want to illustrate different types of accounting treatment outcomes with the transfer of receivables in the form of a basic decision tree. First, we have to consider whether the financing arrangement meets all 3 conditions to be treated as a sale. And if it doesn't, we know that this is called a secured borrowing, which can take 2 forms. Specifically, we would say that we pledge receivables when all of them are being used as collateral, whereas when only certain specific accounts are used in the secured borrowing, we refer to that as assignment. And ultimately, what we're concerned with here is the accounting treatment, which in both cases results in notes payable being recorded and the arrangement being disclosed in the footnotes. Now, let's go back up to the top. If we are able to classify the transfer of receivables as a sale, we're going to write these off the books. We're going to receive some cash and virtually always recognize some sort of loss on the sale. But the next thing we have to consider is which party is going to bear the risk of bad debts going forward. Specifically, we would say that a sale of receivables without recourse is one in which the buyer or the factor, again, we're talking about a bank here, right? They are the party that assumes the risk of uncollectible accounts. If some of the customers default, or for whatever reason the bank cannot collect the cash associated with those receivables, they are the ones stuck with that negative outcome. Alternatively, a sale of receivables with recourse is one in which the seller retains the risk of bad debts. In other words, the company is still on the hook for the creditworthiness of the customers whose accounts have been transferred to the factor. The difference in the accounting here is that a recourse liability must be recognized, and this recourse liability is going to increase any loss on the sale. Don't worry, we'll do plenty of practice with numbers in class. The last thing I want to end on is some discussion of financial statement ratios, particularly those that relate to receivables. Again, here's my usual reminder that we can never look at a ratio in isolation and call it good or bad. It's a baseline figure against which we can compare a company to industry peers or to itself over time. Receivables ratios give us a sense of how quickly a company is getting cash from its credit sales. And there are 2 sides to the coin here. This can speak to the credit quality of a company's customers, but at the same time, It could also be an indicator of the efficiency with which the company is collecting cash from those sales. We'll start with the AR turnover ratio, which will be defined as total sales divided by the average receivables balance during the period. Let me briefly unpack the numerator and denominator here. With total sales up top, really, we ought to be more particular and call this total credit sales, though it's not typical that we're ever going to know this number for a company, so it's an assumption that virtually all sales are made on account when we use this in the numerator. That's something to keep in mind. In the denominator, we would get the average receivables balance by taking the sum of the ending balance of AR for this in the prior period and dividing that by 2. Once calculated, this ratio tells us the number of times a company collected its average receivables balance during the period. To be clear, some customers are going to pay their accounts off on a more or less timely basis. Some accounts are going to be bigger than others, but this turnover ratio is going to smooth all of that out and give us a sense in average terms the number of times we're collecting that normal balance. It can be hard to interpret this ratio on its own, but I like to introduce it as an intermediate step for when we calculate days sales outstanding, which, like everything in accounting, can go by a few other terms. In this case, people refer to this as the average collection period or days sales in receivables. In this class, we're just going to call it days sales outstanding, which is calculated by taking 365 and dividing it by the AR turnover ratio. The intuition behind this math is that if you take the total number of days in a year and divide it by the number of times you're collecting that average receivables balance, this will give you the average number of days it takes to collect payment from customers. Again, I hope you realize that it's not what happens every single time, but roughly speaking, this is our expectation of how long it takes a company in days to collect on their credit sales. So go ahead and hold on to these ratios. We'll be using them later in the semester.